As a property investor, you have the option to choose between the prime cost or straight line method and the diminishing value method for claiming depreciation. Understanding the differences and benefits of these methods can help you make an informed decision that best suits your investment strategy. The diminishing value method. This method applies the nominated depreciation rate to the written down value of the asset each year. This means higher depreciation values are claimed earlier in the life of the asset, with deductions diminishing over time. Next, we have the prime cost method. This method applies a consistent rate of tax depreciation to the starting value of the asset, so it depreciates at the same value every year for the life of the asset. Let's consider a standard Division 40 asset, a security system costing $2,500. With an effective life of 5 years as prescribed by the ATO, here's how the depreciation deductions compare over time using both methods. Using the diminishing value method, the calculations would be as follows. Year 1, $2,500 times 40% equals $1,000. Year 2, $2,500 minus $1,000 times 40% equals $600, and so on. The diminishing value method reduces the amount of deductions available each year, effectively front-end loading the deductions. Using the prime cost method, the calculations would be as follows. Year 1, $2,500 times 20% equals $500. Year 2, $2,500 times 20% equals $500, and so on. This effectively is a flat line rate of depreciation over the effective life of the asset. The diminishing value method offers higher initial deductions, which can be beneficial for investors looking to maximise their tax deductions up front. It's also useful for assets that lose value quickly or become obsolete faster. On the other hand, prime cost method offers consistent deductions, providing a steady and predictable amount of depreciation each year. This can simplify financial planning and forecasting, making it ideal for investors who prefer a consistent return over the life of the asset. Choosing between the diminishing value and prime cost methods depends on your investment strategy and financial goals. A quality depreciation schedule prepared by a qualified quantity surveyor will report both methods, allowing you to select the one that best suits your circumstances. Consulting with your accountant can also help you determine the most advantageous method for your specific situation. For more detailed advice and to maximise your depreciation deductions, consider using a qualified quantity surveyor to prepare your tax depreciation schedule. When selecting a quantity surveyor, ensure they are appropriately qualified, a member of a recognised association and a registered tax agent. This will help you maximise your deductions and minimise your risk. Here at Capital Claims Tax Depreciation, we offer Australia-wide services to help with all your depreciation needs. Call us on 1300 922 220 or get a quote today. We provide depreciation services for both commercial and residential properties. Fill out our simple online form to get started. Let us help you maximise your depreciation deductions and make the most out of your property investments.